Good morning, ladies and gentlemen. As you heard, I am a former regulator. I retired from the European Commission after having spent all my life regulating or trying to regulate the accountants, the auditors, company law, and finally insurance. And the first thing I wanted to ask you, because it's such a beautiful weather and you all seem to be so well rested this morning, I'm going to ask you a very simple question. Who in this room believes that insurance regulation is sexy? Wow, not much sympathy. I'm going to ask you a second question. Who in this room, who is actually an insurance supervisor or works in the insurance area, ever thought when they graduated from wherever school that they were going to work in insurance? You confirm, ladies and gentlemen, my firm belief that insurance regulation is perceived not to be sexy. And that most people end up doing something in insurance they never wanted to do in the first place. That is very important. Because what does it mean? It basically means that there is outside the very specialized insurance area very little understanding about what is insurance, what use does it serve. And that's why it usually does not automatically attract people. And when you were discussing accounting, which has still remained in some way a passion for me too, and you talk about solvency, you will see that a lot of times people do not understand the issues because they don't understand the insurance business model, which is very different from the banking model or any other model. And that's the struggle that we had when we developed Solvency II. And the reason why we did that is that Solvency I, as it exists today in many countries in the world, even outside of the European Union, because we used to export these things to other parts of the world, except of course for the United States, because in the US they only apply the things that they develop themselves, because nothing else can be good enough for the Americans. So they have their own IB system, risk-based capital system, which is a little bit more advanced to Solvency I, but remains well below the quality of Solvency II. So it was designed in the 70s. It was actually developed in the 60s by some academics. Don't do this. Don't let academics develop an insurance regulation. It doesn't work well. And it is not working well because it's not sufficiently risk-based. It looks at the past. If you have to calculate the solvency margin on the Solvency I, is extremely complicated. But the logic behind it is not convincing. It does not encourage insurers to better manage the risk. It means, ladies and gentlemen, that insurers today can sell products which it can never honor and they cannot punished for it. Classical example, we've seen that. Life. You have insurers today that sell life policies, offer guarantees on the market which you will never be able to honor. And it cannot get punished because no capital charge linked to that. And the supervisory authorities cannot do anything about it because they don't have any means. They don't have the facts, the data to see what's going on in the market. It does not attach sufficient importance to the qualitative aspects of it, of supervision, which is very important, as you know, as supervisors, that undertakings, insurance undertakings in this case, are living animals. It's not an academic exercise. You deal with people. And when something goes wrong, it's not because you don't have enough capital, but because you don't have the right people who run the business. And that is very important. We learned that again in the last financial crisis. But we had already learned it in the past when we did some research on this. Solvency I does not have an early warning signal. Very important if you deal with supervision is how can I set up a system that has bells and whistles to tell me before it goes wrong so that I can do something about it. Today on the Solvency I, when you know it, it's too late. It's not good. And lastly, group supervision. I can entertain you for hours about group supervision. It's the most difficult subject in insurance or banking supervision. Because group supervision has to do with responsibilities, with the law, traditions and cultures. Can you imagine in Europe that a French group would accept to have as a group supervisor a German supervisor? Wow. C'est pas très beau, hein? D'avoir les Allemands me dire ce que je dois faire. Hein? It's difficult. It's a very difficult area. So, to remedy your problem, you look around the globe today, most countries are in a stage of development of a risk-based solvency regime. People agree the system needs to be risk-based. We went in our reform to look for situations in various countries of the world, but the problem with insurance was that you have the Basel Committee that once in a while comes in and says to the banking supervisor, now you need to get your act together. We don't have something like that in insurance. Who, ladies and gentlemen, is the international organization that deals with insurance? Thank you, sir. You should know it. If I ask that in a room of insurers, nobody knows it. But I ask on the street, somebody, you heard about the Basel Committee, usually people have heard it in one way or another. But again, this is something that there is not a pressure, and that in Europe made it difficult to agree, and we had some difficult negotiations because there was not that international pressure. So Solvency II is actually a system that was developed in Europe. Not only with European ideas, because it is of international inspiration. And that's Solvency II. If you know this, you leave everything else to the experts. Solvency II is a system which is based on 3 pillars. And you see on this picture, the pillars are of equal size. And these pillars are interrelated. And many people lose themselves in pillar 1. Pillar 1 is a paradise of the actuaries. Do you know the difference between an actuary and God? God knows he's not an actuary. But people get carried away in pillar 1. Because pillar 1 and the Solvency II has all the quantitative issues, the capital calculations. And in order to make it really nice and difficult, contrary to banking, to Basel II, Basel III, we have 2 capital requirements. Aha! The actuaries just love it. You know. We have a solvency capital requirement that you have to calculate for the unexpected risks. That's the trick. Because there's always something that is unexpected. Now, of course, what is unexpected, we have to work on probabilities. We know that. We use VAR, value at risk. 99%, 99.5% value at risk over a 1-year time horizon. So we have a confidence level that's not 100%. Why is it not 100%? Why don't we give a confidence level of 100%? And get to the complicated things like 99.5%. For the very simple reason, ladies and gentlemen, that if we have 100% certainty, we won't have insurance anymore. As simple as that. Because it would become too expensive. So we have to find this. Where did we get 99.5%? Why is it not 99.6%? We took this from Australia. Australia is a country that has more sheep than human beings, but still is very important in a number of areas because they've gone through a number of major scandals. And I always said as a regulator, I love scandals and crises because then I can regulate. And that's what the Australians did. And they have a very sophisticated solvency regime, which is very akin to Solvency II. And they have a confidence level of 99.5%. So two capital requirements, the solvency capital requirements, you calculate using an internal model, possibly approved by the supervisors, or you do it on the basis of a standard formula which we provide in the regulation. And then the solvency capital requirement is like a snake. It's not a straight line. And once you get underneath the solvency capital requirement, it's not a disaster. It's logical. Because we move. We work with living animals, not with dead things, you know. So it's like a snake. And once you go below the next capital level, which is the minimum capital requirement, then the supervisor steps in to close your business. That's the system under Pillar 1. And Pillar 2 adds the failure in Solvency 1. Pillar 2 deals with the qualitative sides. Governance functions. Very important in insurance undertakings, as it is in any other undertaking, I would say, that you need to identify who is doing what in the business. And what we do under Solvency II, we move implicit governance to explicit governance. We write down, we ask people to say what they're doing. The chief risk officer, who is in charge of risk management, will have to write down what he is doing and why his role is different from the chief actuary, who is in charge of the actuarial function, and so on and so forth. So that is very important. We have these governance functions, and under Pillar 2, we also have the ORSA. Because you can develop a system in insurance, a standard formula or an internal model, but it's by definition not perfect. And therefore you will need to modulate things, and you can do that through Pillar 2 additions, capital add-ons possibly. And Pillar 2 also comprises what you certainly have heard about, the ORSA, own risk and solvency assessment. That's very important. It's a little bit like the true and fair view concept in accounting. We should not apply the rules like monkeys. We should sit back at least once a year and think, am I well reflecting in my solvency capital my true risk position? And the ORSA is an interesting instrument for insurance companies to better get to know their risks. And that's why this ORSA exercise is so important in practice. And all parts of the business will have to breed the same risk culture to know what are the issues, what are potential risks that could affect the business. Pillar 3 deals with the area which the business doesn't like, disclosure. The insurance sector in Europe today is still extremely intransparent. And there's a wake-up call. Pillar 3 will profoundly change that. For the first time in history, insurance companies in Europe will have to disclose things that will allow supervisors to know what's going on in the business. That will allow us to answer the very simple question after Lehman's went bust. What's the impact of Lehman's on the insurance industry? That question could not be answered in Europe. Because we don't know. We will. This is costly. We talk about hundreds of millions of investments in IT systems. But it's an investment that once it's made, it should be up and running for a while. Very important. And this Pillar 3 is of course linked to Pillars 2 and Pillar 1. And that's why you should always keep that in mind, the interconnection between all these pillars. And the companies need to make sure that this is also clearly in their business strategies. Of course, Pillar 3 deals both with public disclosure and supervisory reporting. Things which may not be exactly the same as you know. Some characteristics. Market consistent valuation of assets and liabilities based upon IFRS. we decided not to have our own insurance accounting rules, but we said we are going to use IFRS to the extent that it is market consistent. Now the question is, why do we do that? We do that because under a risk-based solvency regime, we want to know the risks, also the market risks. You can imagine, after the financial crisis, when markets went berserk in Europe, the euro crisis and so on, you remember that? The industry came to see me and said, Karel, are you really sure we need to take account also of market risk? Life would be so beautiful, ladies and gentlemen, if you just ignore a couple of risks. Wouldn't that be great? But that's not the way we do it. I'm very happy to deal with you about how we deal with this. But don't tell me to ignore something. A problem never goes away by ignoring it. So we have to attack it. So market consistent valuation of assets and liabilities. In insurance, not so much a problem on the asset side, but a huge problem on the liability side. Because insurance liabilities, which we call in Europe technical provisions, the Americans call them reserves, which is not correct from an accounting point of view, but that's American. But technical provisions, there is no market value for technical provisions because you don't sell these things on the market. What does that mean? It means that our calculation of technical provisions on a market consistent basis is based on an agreement. We do it in this way. Is it the only possible way? No. But we've agreed all in Europe for once to do it in the same way. That is a very important progress. Total balance sheet approach, contrary to banking, even in the Basel III, they don't look at all the risks. Under Solvency II, we look at all the risks, to the extent, of course, that you know the risks. But we try to take account of all the risks from the assets liability side of balance sheet risk. 2 capital requirements, I mentioned that. Internal model, to be approved by the supervisor. 3-pillar approach. Extended and fully harmonized supervisory powers. Very important. We're moving, as I will say later on, we are moving in Europe towards what we call a single EU rulebook. Today, the powers of supervisors in Europe are very different. Stress testing, on-site inspections are not allowed in many of our countries. But these are tools which are absolutely essential for supervisors. So under Solvency II, we have the same supervisory powers everywhere in the European Union. And that's a very important element. And one of the things under Solvency II which is absolutely essential is that Solvency II establishes a dialogue between the supervisor and the insurance undertaking. Today, many countries, when they do insurance supervision, it's basically somebody sitting behind a desk and reading a lots of reports and things and filings and whatever. Not anymore in the future. In the future, insurance supervisors will actually have to know who they are supervising and establish a dialogue. I always say, the insurance industry should look at the supervisor as their friend, not their enemy. That's the logic of Solvency II. No organized war between the supervisor and the supervised. Then the system cannot work. And because we are fully transparent, Pillar 3, we can actually talk to each other because we know each other. That's the objective of Solvency II. That is the big change in mentality, because when I tell the industry, as of tomorrow, you supervise with your friend, they say, Karel, you're out of your mind. I mean, I don't like these guys, you know. When I tell the supervisors, the industry, you should have a dialogue with the industry. Many people in supervision say, a dialogue with the industry? Huh, these shitty companies. Ladies and gentlemen, these shitty companies are your lifeline. You make money from them. So you better take care of them. You feel concerned about what the industry is doing, and it is this trust that is very important in the philosophy of Solvency II. Group supervision on equal level with solo supervision. I tell you, many people in this room come from countries which are host countries. Host countries, I mean by that you are supervising a company that is part of a group, the parent of which is somewhere else. When we started negotiating Solvency II, I remember that many countries came to me and they said, why should I worry about group supervision? I'm based in country A. I am responsible by law to supervise this entity in my country. Whether that belongs to a German group, a French group, an Italian group, a Spanish group, whatever group, I don't care. No, ladies and gentlemen, you should care. You should care whether you're the parent supervisor or the subsidiary supervisor. And that's one of the things under Solvency II. All the requirements which we set at the solo level are also there at the group level. You have to calculate the group capital requirements, MCR, SCR, a group ORSA report. It's very important. We learned that again in the financial crisis, that it does matter. When AIG went into trouble, I cannot describe to you the scenarios. Nobody in the world knew who was supervising AIG, including the US. Nobody. It won't happen again. That's why group supervision is so important, but it's very difficult. Proportionality is very important. We have a system that is complex. Solvency II is very complex, but we need to be concerned of the fact that most of the insurance undertakings in Europe are small and medium-sized. And that's why we need a proportionality principle. We need to ensure that the rules are applied taking into account the nature, the size, the complexity of the business. And that is very, very important. And it's a message that's also there for the supervisors. You know that very well, that supervisors sometimes have the tendency to over-supervise. Don't do it for these small guys, Treat them nicely. Have a nice little dialogue with them, It's very important that we take account of the reality, not of the fiction. It's also true for the member states. I'll talk to that in a minute. But usually the member states of the European Union have a tendency to over-regulate. We call that gold-plating. We develop a directive of 10 pages, which is then implemented by the member states with 1,000 pages. And then everybody complains about Brussels. The problem is in the capitals, because the member states love to regulate. It's great fun to do that. They just take the opportunity to add on. That will be much more difficult under Solvency II. So that is the proportionality principle. Why is it should not be too burdensome? Some examples here: captive insurance and captive reinsurance undertakings. Mutuals have a particular capital structure, as you know. So you need to take that into account. Reinsurance undertakings are also special entities, as are captive, so we need to take that into account. The process we used to develop Solvency II was called the Lamfalussy process. Lamfalussy is a baron who chaired a committee of wise men that introduced a form of lawmaking based on different levels: framework directive, implementing measures, commission, convergent implementation, by close cooperation between national authorities, the supervisors, and then lastly, enforcement. That was the approach that we set ourselves in developing Solvency II. We had the adoption of the Framework Directive, the Level 1, in 2009. We started drafting the Implementing Measures Commission Level 2 between 2009 and 2011. Then EIOPA started to draft supervisory guidance, and then the first state of application was set 1st November 2012. But then we had the financial crisis. It was very funny, financial crisis. You ask the insurance industry, the first thing the insurance industry said when the financial crisis broke out: we are not responsible for the financial crisis. So leave us alone. Did the insurance industry suffer in the financial crisis? We all suffered, so they also suffered. But they suffered less thanks to another financial crisis, the Enron crisis. During the Enron crisis was a capital market crisis. And many insurance companies in Europe had great difficulties because they were heavily invested in equity. And under Solvency I, you don't take account of market risk. So companies had a great problem. And since the crisis beginning of this century, the insurance industry has been doing a better job in risk management of their investments. And it helped them a lot in the financial crisis because most insurance companies did not buy all these toxic products. They were more prudent in their investment strategy. But of course they suffered in the financial crisis because the whole climate has become far more dynamic, or should I say wild, or whatever you want to call it. So it has affected them. We had some discussions about that in Brussels, how this would affect Solvency II. Basically, everybody said we should go ahead with the project, but we had a lot of volatility because interest rates were going up and down like a yo-yo, so your technical provisions were going up and down like a yo-yo, and your own funds also. And that was, of course, not the way Solvency II was intended. And that's why the Commission introduced Omnibus II, which was a proposal that would adapt the Framework Directive of 2009, because we changed CEOPS, the Committee of European Insurance and Occupational Pension Supervisors, into EIOPA, an authority. And as I will tell you later, this is not just a change in name. All of you who work in insurance, you must learn, if you haven't done it yet, as of today, to Google once a day the AOPA website in Frankfurt. It's a lot of interesting material that you can read in AOPA. New powers for AOPA, inclusion of transitional measures to facilitate the transition from Solvency I to Solvency II, the Lisbonization of the Framework Directive because of the Lisbon Treaty, and then change in the date of application. But it took longer than expected to negotiate some Omnibus II. There was an agreement in the Council relatively quickly between the Member States, but the Parliament was dragging their feet, and we had to fix the dates several times. What were the reasons? The reasons were that the volatility that we observed as a result of the financial crisis was particularly relevant for long-term guarantees. Just imagine for a moment, you have a 30-year liability as an insurer. It's a fixed liability. And of course, the counterpart are your premiums that you invest. And these premiums you invest in assets that go down like a yo-yo. Does it affect the value of your liabilities? You say, no, you have separate valuation of assets and liabilities. But then you get imbalances. And that produces volatility. And people came then to the politicians, the insurance industry, and they said to the ministers of finance, unless we do something about this, this will be the end of the life industry in the country. You must do something about volatility. They also went to see members of the European Parliament, and the Parliament then said, okay, if this is so important, I, Parliament, want to have a say in how to deal with long-term guarantees. Now, ladies and gentlemen, have you ever spoken to your minister in a meeting about insurance, telling him which discount rate you have to use? How long will their meeting last? The minister will say, do I really need to discuss this with you? Now, we had in Europe, in Brussels, the meetings between the Parliament and the Council of Ministers dealing with the most complex issues because the politicians wanted to deal with that. Very, very difficult. The Parliament also wanted to have more powers. Parliaments always want to have more powers. And then they raised interesting issues. For instance, how should you treat sovereign bonds? I invest, as many insurers do, part of my premiums in sovereign bonds. What's the capital charge? 0. Why is it? Because the governments have decided themselves that they are not risky. The reality, of course, we've seen. The markets look at that differently. And so the Parliament was saying, Commission, you cannot have a system whereby you give a 0 rating capital charge to government bonds. You need to also introduce a capital charge. But why would we do that in insurance if they don't do it in banking? I mean, we're not masochists. So this is a general problem. Problem not only of Europe, it's a problem of the world. All countries in the OECD, they have agreed that, your national bonds, they are 0 capital charge. Then we had other issues like equivalence, proportionality, and so on. Fierce lobbying by the insurance industry, difficult trilogue progress, so many reasons that explain the delay. The long-term guarantees here in the slide, you see that the market turbulence. We had an interesting debate, ladies and gentlemen. What is the difference between volatility and artificial volatility? Depending where you come from, you come to different conclusions. Should we take account in the valuation of our technical provisions of the spread risk? If you don't, you come to different conclusions. The low interest rate environment makes it difficult to provide long-term guarantees. If you have interest rates of 1%, it's difficult. The smooth transition. I'm an insurance company, I promised 4% guarantee over 30 years. My discount rate is now 1 or 1.5%. If I discount my technical provisions using a discount rate of 4% or 1.5%, it's a huge difference. So how do you deal with that? One-size-fits-all solution is not possible. So we needed to work on that. And so these are the various solutions. I'm not going to go into them, but they all deal with different types of insurance products. The matching adjustment, something which is particularly useful in the case of annuity business. So then we're talking basically about the UK, for instance, or Spain. Extrapolation is very important for the German insurance industry because they have very long-term liabilities. The volatility adjustment deals with the spread risk problem in a lot of countries, Spain, Italy, Portugal, Greece, but also France. Extension recovery period, if you go below the solvency capital requirement, is this a disaster? I told you, no, it is not a disaster. But sometimes if you have a crisis situation, you should give more time to companies to come back to their solvency capital requirement. 7 years possibility. Transitional measure on risk-free interest rates. That deals with the companies that offer interest rates that are well above the market rate today. You have a transitional period that phases out this problem over 16 years. People tell me, Karel, that's crazy. 16 years? It's almost as bad as amortization of goodwill. 20 years or 40 years we had it one day. What is 16 years in a lifetime? We all live longer. 16 years, you need it. You need it because we're talking about a lot of money here. And transitions are not really a problem as long as we have the final goal set. Technical provisions, some countries calculate their technical provisions less prudently than others. We need to give them time to get back. So that is the package, and we have the new approach, which is called the Lisbon approach, means a more detailed framework directive, the role of the Parliament, delegated acts for the Commission, regulatory technical standards, implementing technical standards developed by AOPA to be endorsed by the Commission, and then guidelines and recommendations developed by AOPA. So you see various different measures, and that's why I say what's in a name. It's complicated, you know, all these different possibilities to adapt legislation. Basically, it is a division of tasks between the legislator, which is Council and Parliament, and the supervisors, which is EIOPA. Less role in the future for the Commission. EIOPA works with a stakeholder group. I'm a member of the stakeholder group for insurance and reinsurance. We must advise, we must give an opinion on any draft measures that EIOPA will issue. That is important because supervisors once in a while need to be reminded that they are not writing for themselves, but for, you know, for others. What's the present state of affairs? Solvency II will start 1st January 2016. Omnibus II directive was published in the official journal on the 22nd of May, so fairly recently. So the law is there, and we are now in an implementation stage. The level 2 measures will be proposed by the Commission in the summer of 2014. You know, in Brussels, the concept of summer is a not very clearly defined concept. Huh? Summers can last a little bit longer than the calendar summers, depending on the political necessities. That's the world. That's why I never put on my slides a month, summer. With the scrutiny period, Council and Parliament have 6 months to scrutinize these proposals. The level 3 measures implementing technical standards will be proposed by EIOPA. They are already available in draft form, and EIOPA is already consulting on them. There's 2 waves, one in April, which is available, and where in June the consultation period runs out, and another wave will start in October. There is a phasing in process with the first measures kicking in on the 1st of April 2015. As of 1st April 2015, all the measures must be in place, for instance, for the approval of internal models. We want to use an internal model by the 1st of January 2016, and we need to have an approval process. Everything should be ready to go as of the 1st of April 2015. So that is the system. There's transitional measures in Omnibus 2 which deal with the introduction of parts of the new regime, non-qualifying capital instruments. That's always a big discussion. I have issued capital instruments. How do I value them under my new solvency regime? You need a transition to deal with that. And then for the disclosure, which is very important, in order to make that change not too radical, there is a gradual introduction of the disclosure period so that companies have time to prepare themselves. EIOPA has issued interim guidelines which are applicable as of the 1st of January of this year. They are addressed to national supervisors, and they need to decide whether they are going to incorporate them into their national regulatory framework. These interim measures deal with some areas such as governance, forward-looking assessment of own risk, that's the preparation of the ORSA, submission of information to national competent authorities, and pre-application of internal models. These interim measures are applied de facto in most of the member states of the European Union because most of them have decided to comply with them. Some international aspects, Solvency II, of course, has to take account of the fact that we have groups in the European Union that have operations outside the European Union or are part of groups, the parent of which is outside the European Union, and we deal with that through a process of equivalence, which the Commission will make a number of decisions on equivalence of the solvency regime in other countries in the world so as to to facilitate the operation. EIOPA, I told you, EIOPA is important because EIOPA has more powers. EIOPA sits on all the supervisory colleges, 92 presently in the European Union. EIOPA is responsible for developing a common supervisory culture. They can apply binding mediation. If today the French and the UK supervisors don't agree, what happens? Nothing. In the future, any party can call EIOPA to decide. So they will agree. because nobody wants EIOPA to decide. So that's a good system. So binding mediation, peer reviews. The French can go to the City of London, open all the cupboards at the PRA and check whether they're doing a good job. It's great stuff, you know. Great. Cooperation with the European Systemic Risk Board. So basically the message is, if you want to know what's happening in insurance supervision in Europe, look at the website of EIOPA. Will be further gold plating. Member states have the tendency to do that, but the objective of Solvency II is that we have as much as possible uniform rules in all the member states. That is the intention. Solvency II and financial reporting. Under Solvency I, the solvency requirements are based upon the accounting rules. That was the old view, and you find that view still present, for instance, in the United States. The US also bases their supervisory regime on the US GAAP. That is different under Solvency II. Solvency II only deals with solvency requirements. So Solvency II will require all the insurance undertakings to draw up a solvency balance sheet. The solvency balance sheet is based on valuation rules that are based on IFRS to the extent that they require market-consistent approach. But we can have variations going forward because the objectives of the two regimes are not necessarily the same. There may be some simplifications for the smaller companies in the calculation of some items in the solvency balance sheet. But the insurance accounting rules presently in the European Union are not changed. So in most countries in the European Union, the insurance accounting rules for the solo entities are based on local GAAP that's based on the Insurance Accounts Directive of 1991. Why is that? Mainly, not exclusively, but mainly for tax reasons. And that is not changed. And that's why insurance companies in Europe have their different levels of reporting depending what area they are going to tackle. So to conclude, I think that it's important not to focus exclusively on capital, on Pillar 1. You look at management and governance. Very important, risk management. Finalization of Solvency II is just the end of the beginning. As you will see, there will be a lot of literature coming out of this regulatory framework. Solvency II will have a huge strategic impact on insurance undertakings, will profoundly also change the way in which insurance supervision is carried out. Just remember what I told you, the dialogue. Supervise with my friend. Role of EIOPA will become more important, so national supervisors are no longer omnipotent, as they believe today. Need to stick to a principle-based approach. That's a message I always remind EIOPA of, that we should not over-regulate. And now we go to the questions. Do you believe that the insurance industry is well prepared for Solvency II? It's a guesstimator. It's a guesstimate. But I'd like to know what you think. I'm not voting because I don't want to influence the results. So, what does it say? So still people voting. Okay? Stop. Woo! Maybe. I like that. Maybe. It shows again that supervisors are prudent people. You know, don't ask me yes or no. I say maybe, maybe. But yes is their column is very low, huh? I mean, your view about the insurance industry is not very good. Let's move then to the next question. Now I talk about you. Don't hit the others, huh? Are insurers prepared, are the supervisors prepared for Solvency II? Yes, only to a limited extent, but better than the industry. Not at all. What do you think? Come on, we got a few hesitants. 40, we were at 44 before. Number 44. 46. Oh, seems to be a more exciting question than the first one. Okay, we call it a stop, huh? Maybe. So, again, the supervisor prepared, most people seem to suggest that maybe or no. You see why we have this dialogue? Because you're both in the same position. You're both in the same boat. It's very important to keep that in mind. But let's move then to a more easy question then. Financial statements of insurers, they clearly depict the financial situation of the undertaking. The present ones are a total mess. They're difficult to read because of the complexity of insurance. They are not less clear than financial statements of banks. I wanted to ask you that question because you've all become aficionados of accounting since last couple of days. It's a little bit difficult to answer these questions, but again, I won't vote on this one because I have a clear view on this. Maybe you have never seen financial statements of an insurance company. That's also possible. Or you fell asleep when you saw them. Okay, less enthusiasm here. Huh? 43, 44. We were at 46 in the previous question. 45, yeah, almost getting there. Maybe we'll just stop. I think this somebody could not decide. They're difficult to read because of the complexity of insurance. Isn't that interesting, ladies and gentlemen? Because isn't the objective of financial reporting to give a true and fair view of the financial position of an undertaking? So clearly, all financial reporting rules today do not do that. Because even if the business is complex, financial reporting rules should be able to produce that picture. So basically, for the ISB, the message is clear. You've got a lot of work to do here. Help him, because they need help in getting there. Good. Let's move on to the next question. There is a need to regulate solvency requirements for insurance. I agree. I disagree, because insurance have passed the financial crisis without problems. I disagree because capital does not really matter in an insurance undertaking. I believe that this matter should be left to market forces. What do you think? We're moving. We're moving. I think you will all decide clearly for. I'm not influencing you. 45, number 46 has fell asleep, I think. Maybe we stop then. I agree. Thank you very much. I think it's my last question, isn't it? Isn't it my last? There's one more, yes, but I'm very happy. Now I can go home, tell my wife. People tell me that what I do is actually useful. And that is the one that I wanted to leave in order to introduce the next sessions that will get you into these exciting areas. So the last question. It's another one. Okay, good. So assets and liabilities of an insurance undertaking should be fair valued. I agree. I disagree, because it produces pro-cyclicality. It's a difficult word, pro-cyclicality. We learned it in the financial crisis. I disagree because there is no market value for insurance liabilities. I believe that historical cost is the best measurement basis. I believe in the prudence principle. Oh, la 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 la. You love fair value. I can see that on your face, you know. Nothing is more boring than to calculate the cost, because it's not difficult. 46 is sleeping, so we can stop. I think that your first and your third question, I can understand why people answer the third one. It's true, there is no market value for liabilities, but again, we can invent one. As I told you, it's convention. But I'm happy with your answer. Because if you were to go for 4, it basically means that you ignore market risk. And for an insurer, that's tricky business. We cannot do that. Insurers have 2 sides on the balance sheet, you know. And the asset side is actually also very important. Good. Then I suppose I have, no? It's finished, huh? It's finished. Okay, it's finished. I have no more questions for you, but maybe you have a question for me. I still have a couple of minutes that you can let me know whether you agree, disagree, don't like it, don't care, love it, hate it.
Thank you very much for the inspirational speech.
Thank you, sir.
I come from the Macedonian Insurance Supervision Agency, and I heard of you from my superiors that you are really an expert in this field in insurance. So my question concretely is about, there is one sentence at one of your last slides about insurance accounting. And you mentioned on your first slide that the insurance business model is different than the business model of banks and other industry entities. About insurance accounting, it's true that there is a council directive in 1991 on insurance accounting, and there is one article in this directive that defines the gross written premium and what is included in gross written premium and what is not included in gross written premium. And it says that only due premiums shall be recognized as gross written premium, and taxes and other duties should be excluded from gross written premium. So my question is now, having in mind the work done by the International Accounting Standards Boards on insurance contracts, and whether there will be any change to this definition, and whether gross written premium in future shall be recognized in different matter. Is there some discussion about this issue, and what changes shall we anticipate in future with regard to this?
Yeah, I think at this stage you have to understand that the negotiation of Solvency II, which is the biggest regulatory change in the last 30 years, is a formidable exercise. And I could only manage to do that because I avoided to get into financial reporting. If you get into financial reporting, you immediately get into the tax area. And your definition of gross written premium, you know, why does it include taxes, exclude tax? Because you have this premium tax, which is very divergent from member state to member state. And if you include these premium taxes into gross written premiums, you could completely distort the picture. If you want to know as a supervisor how much business a company makes, you have to exclude the things that poison, pollute, in fact, the business. And tax is one of the areas that does that. Does it then mean that if the ISB were to say we give a different definition, is that going to be a problem? No, it's not going to be a problem, because I don't have any problem to ask them to disclose these other things, so that if you need information, you can have that. We are not doing that yet because I am a pragmatic person in the sense that I will not change something unless things are final. We will wait what the ISB is going to do, okay? We'll wait when they get to something, and then we'll talk about that. The Insurance Accounts Directive of 1991, there is no intention at this stage to change it, because member states have introduced it. We leave that alone. We'll see. We really take a wait-and-see attitude. That's the one I took, and I'm sure that my successors in the Commission have the same view, so that member state can be relaxed about that and don't have to get worried about new changes immediately. But nobody stops. We have the rules in Europe that says that you have to apply IAS IFRS in your consolidated financial statements if you're a listed company. But we say in the IAS regulation of 2002 that you may extend this requirement to the individual accounts or to companies that are not listed. That's a member state option. So a member state that says, I want to be fully aligned with IAS IFRS can do that whenever it wants to do that. But as I told you, many member states shy away from that because of tax. And the second reason, which I maybe should mention, is profit participation systems, which could change. You know, if you move to a fair value system or historical cost, could affect your profit participation. It's very important for insurers. By the way, I was in Skopje yesterday. Any other question? Ah, you're all happy people. That's great. Well, if you know,
I may have a couple of questions,
yes,
Karel.
yes. Yeah, go ahead.
I think the first thing is, first thing I would like to thank you for this presentation. I'm not an insurance specialist, but I do get a better understanding of what is happening right now. The question that I would have is, we do advise regulator about looking to financial statements and to try to reconcile something that has been audited to something that is being produced by the supervisee and not reviewed by anybody. Now, is that going to be possible under Solvency II? Probably under Pillar 3 with the disclosures. Would there be a reconciliation approach between the capital requirement under Solvency and the capital of an insurance company? And is that meaningful?
Well, you raise lots of things that are tricky. One of the issues that all of these people who are dealing with insurance supervision will face is if companies draw up a balance sheet for financial reporting reasons, they will have to have these financial statements audited by a qualified professional. That applies to all insurance entities, at least if you have an EU rule. The question then is, if I draw up as an insurer my solvency balance sheet, does that also have to be audited? That's a question. And that's a tricky question, and the answer that I have given the supervisors is no. Because what is the problem? The potential problem is today that we're going to require two audits. We're going to require an audit for the solvency requirements and one for the financial reporting requirements. And that will increase the cost for the insurance undertakings tremendously. And who pays for that? The policyholders. And that's why I would say supervisors need to be very prudent in moving in that direction. I can perfectly understand that you have an insurance entity that you are supervising. And because you have a good dialogue with them, you don't trust them. You believe they do Mickey Mouse stuff. In that case, on an ad hoc basis, I would say yes. I would like to have an expert from outside who comes in to give me, as a supervisor, the comfort that these people are doing it in the right way. But to do this on a, let's say, on an ongoing basis, in all cases, I would say is very tricky. That is my view. Supervisors, if you ask that from AOPA, for instance, you will get a different answer. I believe that everybody should take their own responsibility. And a supervisor should not offload his responsibility or her responsibility to an outside party. Let's all do and try to do our jobs professionally.
The second question is, do supervisors would have any role in enforcing IFRS or the current accounting standard in their own jurisdiction? And for instance, when you look at the Pillar 3 disclosures that it probably will be similar to disclosure in IFRS, would that make any sense?
Here again, I think we need to distinguish. I think that supervisors, as I said, will continue to apply different regimes for financial reporting purposes and for solvency purposes. So for the solo balance sheets, solo financial statements, the local GAAP will still apply. And local GAAP is based on the directive of 1991. And supervisors, of course, will have to take that into account. But this is one element. And the supervisors may be very interested in that because, not of tax, because they're not dealing with tax, but profit participation. That is important. The solvency calculations will be based on a solvency balance sheet, which is based on IFRS. That's the responsibility of the company. And of course, the supervisors, under their responsibility, will want to be assured that this is going to be applied in a correct way. Now, to the extent that the financial reporting, if I talk about large groups, listed groups, the financial reporting will be done on IFRS basis. You have the involvement of the auditor already, and of course the supervisor to the extent that that is necessary. But I think that it is, your questions really point at the heart of where we are today, that we live in an environment in insurance that will for some time be unfortunate, that we have different forms of reporting that apply because of different purposes. And that brings me back to what you said in the beginning about the difference in the business model. Insurance is a reverse production cycle. So you have an upside down accounting regime, which is not easy. And because of the consequences, particularly for the life business, which is complicated because we talk about guarantees, protection of policyholders, there are a number of requirements which are different from those that would apply in banking or in other industrial areas, and that will remain a little bit of complexity, I'm afraid, for a number of years to come. It's great for you. A lot of work. We need good people to do this.
Thank you very much. A round of applause for Karel, and thank you very much for this wonderful presentation.
Thank you.